Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. We've had a pretty volatile week over the past few weeks as far as markets go. So we want to talk a little bit about where we currently stand within that volatility and what our outlook is going forward. But before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off as normal with our market update to give you a sense for where the broader markets are currently trading. We've had some significant movements here over the past couple of trading sessions. So we want to update you as far as where there's movement, where there isn't, and what type of trends we're starting to see emerge out of that. Then we'll take a look at some of the indicators that we typically look at to give us a better sense for how the other markets are reacting, both fixed income, commodities, as well as volatility. And then I want to give everyone an update on the FANG stocks. Since a lot of the, I would say, market direction has been driven off of these 5 stocks, we want to take a look at where each of those 5 stocks sit. There is a bit of divergence right now within those 5 stocks as far as where there's strength and where there's some weakness. So it's important from my perspective to keep tabs on that. To give us a better sense for the directional view of the markets. We'll then also take a look at some economic and shipping data to give us a better sense for some of the ideas that we have going forward, and then showing you those ideas. And at the very end, if we have a few minutes, we'll try to answer any questions that you guys might have. So the primary question that I think a lot of investors are starting to ask here over the past couple of trading sessions is really, have the equity markets bottomed for now, or if there's further downside. So if everyone can please bring up your chat window at the bottom of your screen. I'm curious, how many of you believe that markets are going to be lower 1 month today versus higher? You can type in L if you think the market's going to be lower, and H if you think the markets will be higher 1 month from today. Okay, so I see a lot of L's, a lot of people believing that markets will be lower, but also a fair amount of H's. But it certainly seems that there are more investors that believe markets will be lower than higher. So today what I will be doing is sharing with you my charts, the economic research that I'm currently paying attention to, and indicators to give me an understanding as to what my market outlook is going forward. And lastly, share with you my ideas for the day. So for the past few weeks, we predominantly have focused our attention first on the NASDAQ 100 index, and we've been referring to this 270 level, which has been support since the initial sell-off. It has provided multiple levels of support since that time, since we broke, once we touched that 270 level, once, twice, 3 times. Finally broke it last Friday, and now we're coming to retest that 270 level as resistance now. Markets just barely touched that 267 level, just below that 270 level. We're about to open up just shy of that 270 level. The question is whether or not markets will make a quick retreat back above that 270 level, or it will touch that level and start to roll over. So I think we're going to get our answer here in the next few trading sessions as to the outlook of the markets. Are we going to have more of a neutral to slightly bearish view? Downside targets here about the 250 level. We've already tagged the 260 level yesterday, and the reason 260 is fairly significant is because for quite a bit of time, the market traded between this 250, 270 level for quite a bit of time. And during that time, the average price that was traded was the 260 level, which is exactly where the market touched yesterday and bounced off of. So it's really important for us to keep tabs on the price action here today to see if markets can continue to push forward. Now, price action was particularly weak during these few trading sessions where every time the markets opened up a little higher, it sold off throughout the day. We started to see this reverse a little bit over the past few trading sessions, both on Friday and Monday, where markets opened up lower and then managed to push back higher by the end of that day. That is, generally speaking, the type of price action that we will see as the markets start to approach a bit more of a bottom here. So that is a very important level to keep a tab on in the QQQ. If you look at the S&P 500, the S&P 500 managed to make it back to those June 5th highs that we talked about for quite a bit of time, tagged that as support, and is now put in a fairly strong bottoming formation here. So the question is whether the S&P 500 will start to push higher, or if we start to see a break below 323. A break below 323, in my opinion, would put us back into a bit of a slightly bearish tone all the way down to the 310 level, which is the 200-day moving average. So those are the levels that are really important to pay attention to here over the next couple of trading days. But if we look at other markets like emerging markets, the emerging markets have remained fairly resilient here, not selling off of the broader market here, still trading in that range-bound market at the lower end of that range. So emerging markets, one of the stronger, I would say, markets to emerge out of this new volatility. But if we look at small caps started to continue to weaken here over the past few days, especially as small caps provided quite a bit of defense on the sell-off, provided quite a bit of return during the subsequent bounce, but it's starting to underperform. We see that on both small caps and equal weight indices. This is a bit concerning to us to see this weakness from small caps and equal weight indices, and just a sheer reversal that we saw yesterday where every single sector underperformed with the exception of technology. And the question really is this a one-day fluke? Is this really a back to technology dominating the sectors and dragging the whole markets higher? That's the question, because yesterday we saw the reversal of that. We saw all the other sectors decline while only technology was the only one that was up on the day. Now, if we look at some of the indicators, if we look at the VIX 3-month to VIX ratio, we're right back into what we would consider very normal territory in between 1 and 1.25. So we're right smack in the middle of that. So the markets aren't too complacent. It's not too fearful. It's just right smack in the middle. So this doesn't provide us with a lot of an outlook, but generally speaking, when we have normal markets like this, markets tend to drift a little bit higher to the upside here. So certainly more of a bullish tone to that volatility index. Same thing from the put-call ratio. We've had pretty much roughly 3 weeks of a continuing improving of the 20-day put-call ratio, meaning we're having a much more balanced put-to-call ratio being traded. And we've had the recovery on the 20-day put-call ratio. The 20-week put-call ratio has also started to reverse a little higher, not quite back to that 0.7 level or higher that we'd like to see. But as we start to see an increase in terms of the number of puts being traded, this becomes more of a contrarian indicator. We use this as a contrarian indicator, meaning when this gets too high, that's actually a bottoming formation for the markets. So overall, things have shifted to a neutral with a slightly bullish tone, but we still remain below some major support resistance levels on the major markets. So we really need to see the markets reclaim those resistance levels before we get back into more of a bullish tone. Until then, we're still in this neutral view here in the general markets. Now, if we look at the volatility indices, they certainly have peaked and started to stabilize. So what we're seeing is volatility still remains very high in the 36% range on VXN, which is a NASDAQ 100 volatility index. So certainly still well above its February or January lows here in the high teens. So when you're trading at 36 vol, what that means is that gives you an opportunity to sell volatility and collect a fair amount of premium here. So the goal here is to really make sure that you have access to the right information to determine what is the right strategies to trade in this type of market environment. When you have higher elevated volatility but fairly stable volatility, this is conducive for selling volatility, selling covered calls, selling credit spreads, selling iron condors. These types of strategies that take advantage of elevated volatility are ideal for these types of conditions. Now, when you combine that with a more neutral view here in the markets, that's really something that allows you to sell these types of premiums, because neutral selling premium, selling cover calls, cash secured puts, iron condors, these are all neutral strategies. So when you have a neutral outlook with elevated implied volatility, these are your ideal conditions. They may not last very long because volatility could explode again, or we simply get more of a directional move here in the markets. But for now, neutral markets provide an opportunity to sell volatility. So when we look at the dollar index, so we've been talking about the dollar index breaking below that $96 level for quite some time now. And what we really have started to see is more of a bottoming formation here, almost like an inverted head and shoulders. And the question is whether the dollar index is going to then break back into that $96 range. Now, this has ramifications predominantly on gold. So gold, as you can see, just started to test that 180 support level yesterday. It did intraday break below that, came back to retest that as resistance. And the question is whether or not gold can continue to hold that level or if it starts to break lower here. So this is a very pivotal moment, in my opinion, here for gold as to see whether that support is broken. If that support is broken, there's quite a bit of downside here, in my opinion, on gold. It would really need to get back above 184, 185 in order to resume that bullish trend. So that's certainly a taller order right now for gold to reclaim those levels. But that is, still very possible, especially if you look at some of the tech stocks, where they currently sit. They're in very similar levels. And the question is whether or not these are going to reclaim those resistance levels or they're going to now test them as resistance and start to move lower. This week, we also started to see a little bit of reaction from HYG, the high yield credit fixed income ETF. Last week during the sell-off, fixed incomes did not blink, did not move at all. We're starting to see high yield start to sell off a little. We saw some flow back into treasuries out of these high yield. Perhaps this is investors, taking some profits, or maybe this is investors starting to get a little concerned about the markets. So when we see HYG start to move, this is some of the early warning signs that we want to start paying attention to. Now, I wanted to take a look at the FANG stocks because we've been talking about this for some time, and Apple has a major line in the sand around 110. So as you can see at the 110 level, this really is kind of a bit of a head and shoulders formation. If it breaks below that neckline, it's got a lot of downside here. But yesterday, on Friday, it did break below that neckline. Yesterday managed to push back above that neckline. And the question is whether Apple can actually continue to move higher here. It does need to reclaim that 118 high here, in my opinion, before this can, we can say that Apple is back into a bullish tone. But right now, looking very precarious. And if it breaks back below that 110 level, we would consider that 110 level support broken and potentially look for further downside here. So Apple in a very precarious, pivotal moment as far as where it's going to be heading next. Really important to pay attention to that. Amazon, we talked about Amazon $2,900 level. It tagged that level yesterday. It has held that level so far, and pre-market it is trading higher here. So Amazon so far holding that $2,900 level, and at least in the short term, more of a neutral view into that 3,100, which is the gap that it has. So right now, I think Amazon is in between this $2,900, $3,100 level. Really have to get above it to be bullish again. A break below that puts us into a much more bearish tone. So as you can see in these FANG stocks, they're all very kind of hanging on by a thread in this neutral area, certainly on the lower end of all of these trading ranges. If you look at Facebook, Facebook recently broke below the 250 level. It didn't move too much below it, so this could be just a little bit of an overshoot, and we'll start to see a removal back into that range again. But again, that's not certain. We did break below that 250 level. It is opening up below that 250 level again today. So it is possible that a name like Facebook starts to continue to see some further downside here to the downside. And if you think about the business model between Facebook and Google, very similar, advertisement. And if we look at Google, Google's significantly weaker here. Google managed to get all the way back down to the 200-day moving average, which is just about the 1,400 level, and it's opening up below this 1,450 support level. That was a major line in the sand here for Google, or Alphabet rather. So these are some important levels to pay attention to. I think that you might see a little bit more further weakness from Facebook here, similar to what we're seeing in Google. Lastly, Netflix is really the strongest of these, still holding the major support levels that it's had here for the past few months. Netflix did not take off like the other stocks as much, which is why we're also not seeing as much weakness. But this is one that did hold that 460 level. It is trading a little higher here. So basically Netflix back into a trading range. We might see more of the streaming stocks become more of a favored play here, especially as coronavirus cases continue to escalate both in the US and globally. We see it across Europe, we see it across the US. We've now had a pretty significant uptick in terms of cases over the past week or so. So this could bring back kind of the lockdown stocks, if you will, the gaming stocks, Etsy, eBay, some of these stocks that have really taken a bit of a hit here over the past few weeks. We might see a bit of a resurgence here from that. And lastly, Tesla's still putting in this kind of topping formation here. Still can't get above that 450, 470 level here. So opening up lower here. So I do think Tesla going into battery day is looking a little weaker here, as that is later here today. So let's take a look at some of the employment data. So actually, before I do, just a quick recap. Markets, all at pivotal moments, most of them trading below some major support levels, but just hanging on to those levels by a thread. We could see these stocks, these ETFs or individual stocks reclaim these resistance levels. And if they manage to trade back above their prior recent highs, then we could potentially say that we're back into more of a neutral, slightly bullish tone. Until then, I think we're much more in a neutral, slightly bearish tone at the moment. Indicators are all kind of in that neutral area at the moment. So a lot of uncertainty around markets. So really pay attention to here in the markets over the next few trading sessions, especially look at the intraday price action. You know, do markets open up higher like we are about to open up today and then start to trade lower? That certainly is weaker price action that we don't want to see if we are expecting more of a bullish tone. If we see markets open up higher and then start to trade lower and start to push new lows, that's bearish, and that's what can help inform our decisions intraday. So if we look at some of the employment data, this is really to look at some of the, not only the headline numbers, but some of the underlying numbers. And some of the ones that I think is most important to look at is underutilization and underemployment, meaning people who are employed but not employed in the jobs that they were employed in prior to COVID. And as you can see, those sit at some pretty elevated levels. Underemployment in around 11%, underutilization at about 18%, meaning this is typically someone who had a full-time job is now working part-time because they can't find the same full-time job, despite the headline numbers looking fairly strong here, 8.9% in terms of the headline unemployment numbers, but you definitely see a significantly underemployment and underutilization. And this is, in my opinion, the underlying number that's more important to take a look at. Also, if you look at job recruitment and just general job hiring, it is significantly lower than pre-COVID numbers. And this shouldn't be the case considering we are supposedly in a very strong rebound right now in terms of the employment for US in the US here, and we have seen that predominantly stall here over the past few months, and this is likely going to create a fairly significant drag here on the US economy, which 70% of it is driven by consumer spending. When you have underemployment and underutilization, that is generally going to lower income levels, and then especially as we see stimulus numbers start to fall off, or the stimulus start to fall off, we're going to start to see income levels also come down with that as well. So this has longer term ramifications that's going to likely last for the next few quarters, next few years. These are the things that we want to pay attention to instead of necessarily the headline numbers. Now, as a result of COVID, there also have been certain industries that have generated a fair amount of tailwind as a result of it. And shipping is certainly one of those industries. And these are some of the ideas we want to share with you here today. If we look at shipping indices, they're back to prior COVID-19 levels. They are now starting to have some significant rebounds. We're seeing this both in terms of freight levels as well as the cost to ship freight as almost gotten back to 2018 highs, both on flatbed, vans, different types of shipping components. You have seen some fairly significant gains here, and we don't expect this to reverse here. We actually expect shipping to remain fairly elevated here, so we want to talk about some of the stocks that sit within the intersection of shipping and technology that will likely provide some tailwinds for those types of stocks. So one of the stocks that I want to take a look at is CHRW, CH Robinson. This is a stock in the logistics space. Not only do they deal with freight, they also deal with the logistics and the technology around managing logistics and helping companies that need to ship their goods book freight, whether it's cargo or freight, trucks or underneath a plane. And they've recently launched some new technology that allows customers to be able to book things fairly quickly. And I like this setup. I actually initially brought this up when we had that initial move, but I like this even more, that the fact that it's now pulled back to that support level, to that breakout level around 100. And this is the opportunity that I see to play for further upside here. So CHRW is certainly one of those stocks that I'm paying attention to. This is not quite like FedEx, right? Because this is a stock that I think is much more in the middle. This is more of a middleman, if you will. So this is more of a slow grind, but it's also a bit of a safer play, in my opinion, than a name like FedEx. Costco, we also like Costco here, because if you look at the long-term weekly chart here on Costco, as you can see, you've had multiple pullbacks to that 20-day moving average. It broke below that, had a lot of kind of sideways movement, but recently broke out above that 320 level, is now coming back to retest that level as support and is starting to move higher here. So this is another opportunity, especially that breakout above that 330 level. We've come back to retest that as support, and this is the opportunity that I see for at least a neutral tone here for Costco, because we do continue to see consumer spending at warehouse shopping centers like Costco remain fairly elevated. Whether it's because people are still at home and predominantly cooking as opposed to going out, this is where we see Costco continue to remain supported as a result of COVID. We don't think that this trend is ending just quite yet. And the fact that Costco pulled back to that 330 level, bounced off of it, is certainly supportive of that. On the flip side, when we look at that employment data and we see the number of underemployed and the lack of uptick in terms of hiring, this is really where names like ADP, which processes payrolls for hundreds of millions of people, are starting to see significant declines. And we see this obviously a lag the overall market as employment remains fairly weak. And we recently saw this start to break below a major support level here around 130, 131. It hasn't quite broken below that level yet, but this is one that I'm paying attention to, because if it breaks below that, I see a fair amount of downside here into that 100, 110 level in terms of support. So this is where the one that we see some fairly significant moves to the downside. If you look at the weekly chart, it is broken below this 200-day moving average here to the downside. So we see some weakness here on any type of employment related stocks like ADP, which is definitely by far the largest one of all of them. And lastly, looking at the semiconductors, which have predominantly been pretty strong, focusing more so on the ones that have a 5G chips, like Qualcomm, certainly is one that I think is interesting. What I like about this particular trade is that you kind of have this a little bit of head and shoulders formation, but it hasn't broken below that neckline. It is holding that 110 level here, so I have more of a neutral view here of Qualcomm. And this is the type of trade where you can sell a put credit spread, collect some premium if Qualcomm sits above that 110 level. But if Qualcomm breaks below 110, you can quickly get out of that trade and get stopped out fairly quickly and risk a fairly small amount of capital to do so. And if Qualcomm does remain elevated because of the 5G upgrade cycle that is starting to come out here in October, November, December, this is certainly one that I think is worth holding potentially in your portfolio as at least a neutral view here in the short term, and potentially long-term bullish view if we do start to see 5G take off here in the US. So those are some of the ideas that we're currently paying attention to here in the broader markets. But like I said, overall, we're in a very pivotal moment in the broader markets. Keep an eye out on the major indices. The Qs right now opening up just less than 30 cents away from that 270 level. So we're just at that level. Let's see how markets react after the open to that level. If it breaks back above it with a fairly strong amount of price action, direction or if it starts to get weaker as you approach that 270 level. Keep an eye out on that. That's going to help you give you a better understanding as to how markets will play out for the rest of the week. With that, I want to thank everyone for taking the time out here this morning. I really hope that this was useful in helping you better understand how to look at the markets for this given week. With that, have a great trading day, and I'll see you guys here next Tuesday.